bank and PSU debt fund is 80% invested in PSU and banks. What about rest 20%? How safe is it?
Okay. So the banking PSU, the mandate from SEBI says that minimum 80% has to be invested in instruments which are issued by banks and public sector enterprises. So PSU and banking fund is that. So minimum 80% has to be in those asset classes. Now the 20% is the flexibility with the fund manager. If he wants, he can take a non-PSU kind of corporate exposure. Okay, some fund managers, depending on what is the philosophy that they follow within the AMC, they might say that I will buy 100% into only PSU and banking investments. So that 20% is flexible. It can go into corporate bonds, it can go into government bonds, it could go into low duration government securities like a treasury bill, just to manage the liquidity or the cash aspect. So that flexibility is with the fund manager. It's a very safe fund to invest because your 80% is going to get into AAA rated instruments. Okay, so the exposures, and two, please also remember that most AMCs, especially in the debt context, you will find the portfolios are pretty diluted. So the exposure to a particular corporate or an issuer will be very limited. So even in the case of some bad event that happens, your exposure gets limited, and that is one of the things that you should look for in a debt mutual fund portfolio. One is the credit quality of the portfolio. Two, what is the kind of concentration risk in the portfolio? If the concentration risk is low and if the credit quality is good, you can safely invest in those investments, especially going to be a banking PSU kind of fund.